Hello, everyone, and welcome back to another installment of our periodic Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an analyst and the Senior Relationship Manager also here at Zacks Professional Services. And today we're going to be talking about a strategy to help uncover companies that may be essentially left behind with this entire tech rally that we've seen over the last really decade, but especially so over the past 1 year. This is a potential approach where we can start to look at other names out there that have not gotten so much press coverage and have not had such a large, interest or, appreciation of their stock price. So that is what we're going to kind of talk about here today. And so what we're going to kind of look at is a couple of different things in order to basically find companies that are trading at a discount, a very, very steep discount to intrinsic value. So what we're going to look at is what are some of those items that we can use in Zacks to find that. And as a, just as a sort of, housekeeping, I will just show this disclosure here as well. And, as we continue along, what are the first couple of things that we should note? First and foremost, there's a difference between searching for low price multiples like PE or price to book or price to cash flow, and looking at companies that trade at a discount to intrinsic value. And this is a concept that so many of the great investors of our time have talked about repeatedly. Warren Buffett and Charlie Munger come to mind, and some of their contemporaries, as well as some of their peers like Peter Lynch, come to mind. And this is where there's a big, big gap in understanding of what value is. So the first thing that I would kind of recommend is, avoid placing an excessive focus. Not to say that we should ignore it completely, but we shouldn't place an excessive focus on absolute price multiples, right? So we shouldn't just buy a stock because it trades at a low PE, like a PE of 10 or 15, or even less than that. They can be certainly useful, but they should not be viewed in isolation, right? And what's a better function or a better use of price multiples, if we are going to use it, is to focus on relative price multiple contraction or expansion. So we're going to take a look at that using ZRS, and this is something that ZRS is excellent at doing. And also, I should note, if you do have any questions as we go along in this presentation, please do type them into the GoToWebinar panel. There should be a section for questions in there, so please do post them whenever a question comes to your mind, and we'll spend the last couple minutes of this call reviewing any questions that anyone has. So, so rather than looking at absolute price multiples, we should look at relative price multiples, and the Zacks Research System software has that capability of doing that. So we're going to take a look at that here. The majority of the focus, I think, should be on comparing today's market price to our estimate of intrinsic value, which is based on discounting future earnings. So we're going to look at our Zacks valuation model as a big part of what we're doing here to find companies that are trading at such a discount to what we think is a intrinsic value. And then lastly is the margin of safety, and this is actually the title of a book by Seth Klarman, and a concept that was identified many years ago by Ben Graham, the legend of value investing, which is that we want to find companies that trade at the widest discount or the widest margin of safety, which is the spread between the current market price and our intrinsic value. So we want to find companies that have the biggest and widest spread between those two. And why is that? And that's because it allows room for error in our future earnings and interest rate forecasts. So obviously no one is, it's next to impossible to get right what a company's future cash flows are going to be 5, 10, 15 years out, which is what we need to build a good discounted cash flow model. So no one's going to get that right, and it's hard to even find someone that can get that, to 50% accuracy. So the reason why it's very, very difficult to do that, because it's so difficult to do that, we want to find companies that trade at the widest margin of safety as possible, which gives us room for error. So even if we think that a company can grow its earnings at, say, 10%, if the margin of safety is very, very wide, then we could be wrong and say that the company didn't grow at 10%, but maybe it grew at only 5%. But if our model says that even if we're wrong by that wide of a margin, and there's still upside potential even with that reduced growth forecast, then that's where that gets interesting as far as finding these deep value opportunities. We want as wide of a margin as possible. We'll take a look at that here in a second. Secondly, is return on invested capital, and this is kind of a concept that is joined at the hip with value investing, which is why should we look at return on invested capital? Because it's the single greatest metric to reveal stocks that are cheap for a reason. There's many companies that trade at low multiples, but very few that trade at both low multiples and have very attractive returns on invested capital. So this is one major avenue that we can take to separate, the junk out there from the true gems out there. So it helps us avoid value traps. And what's the general calculation? This is a general approach that I use personally, which is looking at Ebit, right? That's the operating income of the company, divided by its net working capital plus total long-term assets. And this approach is based in part by a white paper that was done by Credit Suisse, the authors of which are Malbusin, I may be butchering the pronunciation of his name, and Callahan. They're the co-authors of that paper on return on invested capital. And they use NOPAT in the numerator, which is net operating profit after tax, but the denominator is the same. I use Ebit just because it makes it a little bit simpler and easier to pull from the database. The only difference is they look at it after tax, and I'm looking at it before tax. That's the only real difference between the two approaches. But essentially both, regardless of which approach you use, as long as you keep it consistent and look at the trend of that number over time, it's going to tell you basically the same thing, which is it shows the rate of return that the company generates on its capital base. It measures capital efficiency and capital deployment, and it tells you what the compound growth rate is over long periods of time. So this is basically analogous to, say, the interest rate that you can get on your savings account. If you're shopping around for banks, where to put your savings into, if one bank is, offering, 0.1% interest, which is what most banks do, maybe not even that much. But some online banks, for example, like Ally Bank and I believe Barclays as well as Goldman Sachs, I believe, has an online banking product, and they offer, much more attractive interest rates like 0.5% or 0.6%. So basically, the point is that, it's kind of like searching for which company has the best interest rate, which bank has the best interest rate. In the same sense, the return on invested capital is the rate of return that the company generates on its capital base. And there's a whole webinar that I did on this, previously. You can go to our YouTube channel. If you just go to YouTube and search Zacks Pro, you'll see all of our videos, and there's one titled Return on Invested Capital. Check that video out if you haven't seen it yet. But this is basically a key concept that all of the great investors have utilized in conjunction with value investing, looking for low multiple stocks, looking for companies that trade at a discount to intrinsic value. We also want to make sure that those same companies have very attractive returns on invested capital, because we'll see that companies may have good growth, But if it requires a lot of invested capital to achieve that growth, then returns are not as good as companies that are a little bit more asset light, if you will. So we're going to use that as well in our overall analysis. Lastly, we want revenue growth, right? This is very simple. Everyone knows this. And the reason for this is a little bit different. We're not using revenue growth as a way that, kind of growth investors look for, which is very high growth rates on revenue. But what we have seen is, stocks with extremely low multiples are often businesses that are being disrupted, right? So we're seeing new technologies replace what they've been doing. The most obvious example would be the rise of e-commerce and how that has disrupted, brick and mortar retail, right? So we want to see, stable revenue, maybe not high growth in revenue, but at the very least, we want to see stable revenue for these, deep value, low multiple stocks. There could be, stronger competition, or maybe there's really just poor execution by management, which is, stymieing their revenue growth and their ability to, to maintain market share. So at the very least, we just want stable revenue growth. So it's just an additional filter to help filter out, companies who are going through extreme, difficulty in the product or service that they make. So that's our third filter. So if we bring it all together, there's really four, key criteria. I just identified three, but there's two within the same one. One, which is revenue growth, right? So we said it doesn't have to be high necessarily, just something above zero, right? High returns on invested capital, or we want to see a high rate of change of that ROIC. Okay. We want to see deep multiple compression on a relative basis, and we want to see a large discount to intrinsic value based on modest EPS growth forecast. So we don't want to be a hero. We want to just see what has the company historically been able to do, and what is the company doing today to make sure that that earnings growth can continue. Maybe not at a higher rate, but just what they've always been doing over the last couple of years. So we're going to bring all four of these items together to find stocks that match that criteria. And I have 6 stocks here that we can review here today. So these are the 6 that I've kind of highlighted here that can kind of begin to, get the gears turning as to how we can apply these 4 principles, and how we see that, manifest themselves in these 6 companies. So we've got Sprouts Farmers Market, which is a high-end organic grocery store chain. We've got Best Buy. We've got Teradyne. Best Buy, we all know what they do. Obviously, they're a brick and mortar retailer. So that's, usually an area of concern for a lot of people because, brick and mortar obviously is getting disrupted by e-commerce. But we're going to take a look at why Best Buy is actually, has been weathering that storm quite well, and how they've adapted themselves to that new environment, and how they intend to compete with the rise of e-commerce. Teradyne, which is an industrial favorite, we're going to take a look at them. Autozone, another retailer, but also we want to find out how have they been adapting to the shift in online. AbbVie as well, which is the global leader in oncology and immunology, as well as Hewlett Packard, which is an old favorite from the 90s. One would think that if you haven't looked at Hewlett Packard lately, then you'd think that this is a relic of the 90s, and why should we be interested in them today? So we'll actually use all of our principles of deep value analysis to help answer the question as to why these companies are attractive. So we'll start with the first one there. So let me dive into ZRS now, and we're going to take a look at Sprouts. So I'll type in SFM in our main ticker box here. And what the first thing we're going to do is I'm going to look at our research report directly. And this is a great resource as well, especially when you're looking at companies that you're not familiar with, because it's a great synopsis of what the company does and what has been the story over the past quarter to 4 quarters. So the summary, the executive summary right here on this first page tells you exactly what's been going on in the most recent history of the company. And you can see that shares of Sprouts Farmers have, increased and outpaced the industry over the past 3 months. The company's focus on product innovation, emphasis on e-commerce. So again, this is going to be a focus for a lot of these retailers that we look at is A, how are they adapting to the shift to online sales? Or B, how are they sort of adapting or insulating themselves from e-commerce? Namely, how are they providing services that online sales simply cannot do? Right. So we're going to see that, as a common theme for all of these retailers that we look at here today. But you can see here that there has been an emphasis by management of Sprouts to, shift as much of their sales online as possible. And they're also doing delivery. They've adapted quite well to the COVID situation where, they've had a lot of success with curbside pickup. And you can see some of that analysis and commentary in, pages 2, 3, and 4. So we can see that page 2, sometimes I jump to page 2 immediately just because this is an overview of what the company does. So if you're not familiar with what they've been doing or are not up to speed on what the latest has been, then page 2 is usually the first page that I look at in this report because it tells you what exactly they do and how they got to where they are today. So this, Sprouts is a Phoenix, Arizona-based company. They have, as of January 3rd, 362 stores in 23 states. Those stores have been rapidly expanding. If we dive into some of their, financial statements, you can see the growth in stores. And here are some of the key reasons to buy: impressive Q4 performance, growth in same-store sales, strategic initiatives as well. You can see that they've been, expanding their customer base, taking in several initiatives focused on product innovation, customer experience. Also, if you read into this, they also are placing an emphasis on their own, private label. So this is a key differentiating factor for a lot of, grocers because grocery stores are, very, very pressured by margins. Now, with organic grocery stores, that's a slightly different story. Their margins are a little bit better than the average grocery store, but with higher margins, that also comes at a cost, which is less revenue, where the vast majority of revenue comes at very discount grocers like Kroger and others. But with an emphasis on private labeling, that's where you can get a little bit better margins. And that's what Farmers has been, or that's what Sprouts Farmers Market has been doing. They're also being, emphasizing technology, the use of, online and apps to place orders. So that's a big, big part of their success story here. Now, we see here that, they're doing a lot, but let's see what has their growth been doing. So if I shift over to revenue growth, so we'll go over here to charts, fundamental history, size, revenue, trailing 12 months. Check out their revenue growth. I'm going to turn off the S&P over here as the benchmark. And look at that growth here, 15%. So this looks like a growth story here. Obviously, growth on the aggregate is a little bit less important because this can be distorted by growth in the number of stores, which has absolutely been the case for Sprouts. But still, you can see that aggregate revenue growth has been 15% over the last 7 years or so, since 2013, 15.7%. So one would think that with a 15% growth, they should have a PE of, 20, 25 maybe, at the very least in line with the market. Well, if we look at their, relative, earnings or, price to earnings multiples, look at that. Trading at a PE of under 13 right now. If we toss on the S&P 500 average, onto this chart and make it a relative chart, and this is a big, big part of what Zacks can do here, this ZRS system, is looking at relative multiples over time. Look at how deep of a discount it trades to the S&P average right now. trades at a 0.59 ratio. So that means it's trading at a 41% discount to the S&P's, forward PE. And over the same time period, the median relative multiple has been 1.2. So it's trading at not only an absolute discount, but it's also trading at a huge discount to where it normally trades at on a relative basis at 1.2. And even if we shorten the time frame here a little bit, you can still see this relative PE multiple compression that's been going on for many years. And now we can see that there might be a little bit of evidence of a stabilization in that relative multiple. We'll see if that holds here. But we can even see this for other multiples too. Like if I shift over to price to free cash flow, right? We know that they've been expanding their stores. So let's adjust that by looking at their free cash flow, because by investing in new stores, that should be hitting their CapEx, right? So free cash flow should be adjusted for whatever investments that they're making in growing their number of retail locations. So we would think that free cash flow should be a little bit less attractive than earnings, right? Because they're investing so much in growing their number of retail locations. But even with free cash flow, you can see that it's been compressed heavily over these past several years now. And look at the discount it trades at on a free cash flow basis. It's even steeper than earnings, trading at a 75% discount to the market versus a premium of 3%, which is normal over this 5-year period. So this is extreme multiple compression for a company that has no essential fundamental problems. We see revenue growth of 15%. Our analyst report also mentioned increasing same-store sales as well. We see that they're shifting towards making as much investments in technology as possible to make online ordering as easy and simple as possible, as well as home delivery. There's really not a whole lot going on with regards to any systemic or structural problems that this company is facing. And by the way, they're also facing a general tailwind, which is increased interest in health foods. And so more and more people are shopping at, higher, organic, groceries. So that's another secular tailwind that they're experiencing as well. Obviously, there's a lot of competition within this space, but that's always been the case, right? That's always been there's no new threat that has come up. There's always been stiff competition within the grocery world. And they've, weathered that by growing revenue at 15%, as we just saw. If I shift over to the valuation model, then we can see here that, just by looking at a default starting point here, which is assuming just 9% growth, a very tame 9.25% growth, look at our margin of safety here, 91% upside. Because we're trading at such a low multiple, given this growth rate, a more justified multiple would be somewhere around, a 24 to 25 times forward earnings, given our total discount rate right here of 5.2%. So we have a very high margin of safety, right? Even if Sprouts cannot grow at 9.25% long term, or let's say, the big talk of the town right now is interest rates. So let's say the 10-year Treasury goes to something much, much higher. We can model that out and say, let's say it goes to 2.5% from the current 1.5%. Even if that happens, we still see a very, very high, expected return on intrinsic value. So because the stock is so cheap and because it has earnings growth, on a relative basis or on a intrinsic value basis, this is a very, very attractive investment at this point at 12 times earnings or less, and with revenue growth. And lastly, we'll look at what have they been doing with their return on invested capital. So I'm going to shift over here to our Excel template, and this is a template that I've been building for some time. And basically what this is doing is, going back to our calculation here, we want to look at Ebit over time relative to their total invested capital. So that is our net working capital. plus total long-term assets that the company has, right? So this number will be adjusted for any investments that they're making in growth. So we want to know what is the rate of return that the company generates on all of its assets, um, long-term assets plus their net working capital here. That is our invested capital or our total capital base. And if I look at Sprouts here, I'm going to type in SFM for now. I had AbbVie here before, but let's shift over to SFM. I'm going to come up here to Zacks and click on refresh all. And it's going to go ahead and refresh all of this data. This is the Excel add-in, by the way. So if you're not familiar with this, this comes with the Zacks research system as an add-in here, so that if you do have access to ZRS, then you also have access to this Excel add-in here. So if you're not familiar with how to get that, please do email us at zrs@zacks.com, and we'd be happy to get you up and running with this. And so check this out here. This is their return on invested capital, 17%. And that's despite making investments in growth, right? 17% ROIC. That's what we want to look for. For a company that trades at such a low multiple, right? If I were to toss in GM or Ford, you'll see exactly why those stocks trade at such low multiples, right? They generate ROIC in the low single digits, right? As opposed to Sprouts, which, trades at a very similar multiple as those companies, and they have, 17% ROIC right now. Also, what we want to make sure is what's been the ROIC over time. Because a company may have good ROIC right now because maybe they exploited something that has been a instant hit, right? But if they can, sustain that over multiple years, then that's a different story. Because maybe they have exploited something recently, but if that's the case, then the competition is going to come in and replicate whatever that success story has been. So if a company has high ROIC right now, that's good. But we want to see evidence that they've been able to maintain that over time. And that's what we see here with ROIC, really going back to 2012, 2013, 2014. This has been something that they've done consistently with a brief, hiatus in 2019. And if we go into the table, I'm pretty sure we can see that that was due to, a bigger investment cycle that they made. Because if I see here on the right-hand side, we see the same exact methodology, but with a 1.5-year lag. So that basically looks at Ebit today using their invested capital from 1.5 years ago. So under the logic that, the logic behind that is saying that it takes about a year and a half before your investments start to bear its fruit, right? Because if we invest today, obviously it takes a while for that to ramp up. For the community to find out that there's a new location here, and for them to get more of a brand awareness or appreciation of that locality. So if I were to lag 1.5 years, you can see that consistently they've been doing north of 15%, comfortably. In the latest period, that's about 17.2%. In 2019, that's about 15.9%. So this is what we want to see: consistency in ROIC. Either high ROIC and consistency in that, or increasing ROIC. So that passes the mustard. So again, that's a great example of, a deep value opportunity in the market right now. We can see the same exact, story with Best Buy, right? That's the next company that we were going to look at. Best Buy is a, big box retailer. We've known them for many years, through the 90s. I know I, love to go to Best Buy all the time. And it's been a phenomenal business because they have been able to withstand the rise of Amazon. And if we look at the research report of Best Buy, obviously we know what they do. They retail technology products as well as kitchen products. But the big differentiator has been their emphasis on the store experience, as well as a few things that online cannot do, which is offer attractive warranties, as well as perform services. So we can see here that within their domestic operations, they generate online sales. So not only have they been successfully shifting to an online business model, but you can see here that a big part of their success is Geek Squad, right? And the Geek Squad is their service for computer repair, as well as their services that they offer for in-home experiences. So when you buy, for example, a TV, who's going to install it for you on your wall? Or if you buy a home theater system, who's going to come in and install it for you? That's Best Buy. So Best Buy has really shifted over to the services side of things and really banked on that being the primary driver of margins. So that's the key differentiator that they have successfully executed on to differentiate themselves from, Amazon and the shift to online. So you can see that, what exactly they've been doing on this page 3 right here. Surging digital sales, building the new blue. So that's their entire new initiative that they have, started to, pursue, which is, cost containment, investing in people and systems. They're also testing new store formats and reducing the shoppable square footage to about 15,000 square feet from an average of 27,000 square feet. So they are reducing their floor space because the idea is not the size of the store, but simply the combination of online and in-store. Because, I think what Best Buy has realized is that there is a psychological advantage to both the convenience of online, but also the psychological sort of security that people feel because they know that there is a store nearby them where they can go to talk about any issues that they have or to make a return. Or that they have that, peace of mind that they know that they have someone that they can speak to in person regarding their purchase, which simply isn't the case with online sales purely. So, Best Buy has really executed quite well. We can see their revenue growth really reflects that. If I shift over to revenue growth here, again, we want to make sure that revenues are not going down. And look at that. This has been the exact opposite here. Pretty tame revenue growth again. So we're not looking for high growth necessarily. We just want to make sure that this is a company that's not being disrupted and is weathering the storm with whatever that they're facing. So we see that there has been pretty good. If I shift over to the relative PE multiple, what's been going on there? We can see that same exact thing. Not only do they have a very low and tame, forward PE at under 13 times, almost the same as Sprouts. But if I shift it to on a relative basis, relative to the S&P 500, that's been, an incredible compression that's been going on here. Again, trading at a 41% discount versus a 38% discount or 28% discount on a median basis. So again, very, very attractive relative PE multiple compression. Let's take a look at the valuation model. And here is that, margin of safety that we always like to look for. This is a little bit of a different case here where we see, we're modeling only a 2%, growth. We see at a 2% growth rate, it doesn't have a huge rate of return. Only has, actually, it's roughly trading in line with where it should be trading at if we were to assume just 2.25% growth. So what we need to do is dial up what our growth expectations are in this case. So if I were to shift to least squares growth and go back a little bit further here, say to over a 10 or 15-year period, you can see the difference in returns here. Now it starts to get a little bit more attractive at a 21% upside. So that's a pretty good margin of safety. But if I go to a shorter time frame here, because the 15-year period, 15 years ago, the business model was quite different from what it is right now. So if I reduce that, to say a 10-year, period, this, reflects a little bit more about what they've been doing in more recent terms, in the wake of, rising online e-commerce sales. that's where the margin of safety starts to, really show its true colors. So this is basically saying that if Best Buy simply continues what they've been doing for the past 10 years, roughly a 10% earnings growth, on the backs of 3 to 4% revenue growth, then you can see that the margin of safety gets really, really impressive at about 80 to 90%. Let's look at the ROIC on Best Buy. Type in BBY. Same thing there. Go to refresh all this and look at the numbers for Best Buy. Again, this is very, very critical because, again, for a retailer, right, we want to make sure that they are generating attractive returns per dollar of capital that they're deploying, right? And that's the big focus that we have. Check that out there, 28% ROIC. This is very, very attractive. For a company that trades at such a low multiple, a 28% return on the capital that they deploy is excellent. And not only is that good for right now, but we can see that they've maintained that over the past several years. And we actually see a shift upward, really in 2016, which is when they started to change that entire business model. So I think management really deserves an award for being able to successfully navigate the company, in the wake of extraordinary competition from Amazon and other online retail, giants out there. So, Best Buy has really been able to withstand that and really evolve the company, and shift it away from not just, retail sales, but offering complementary services that pure online only stores simply cannot do. So big kudos to Best Buy management for being able to navigate that and to execute that, really. So the other company, I'm trying to go through these as fast as possible, because obviously we're time limited here. But Teradyne is the other, big, idea that I had. Teradyne is a little bit different from the others, where it's not trading at a super low multiple, right? We can see that Teradyne, trades at a roughly 23 times forward earnings, which is not super cheap, right? But it is in line with the market, and that's also unique and interesting. It trades at roughly a 6% premium to the market. Okay, so that's not, a huge, multiple compression or a discount. But it does have, attractive, other attributes that the company has that the S&P 500 aggregate simply doesn't have. So let's look at what does Teradyne do. Teradyne is one of the largest suppliers of semiconductor testing equipment. So it's used by manufacturers of semiconductors. So their products are used by semiconductor manufacturers to do performance benchmarking. So that their biggest client base are essentially your huge semiconductor companies out there, as well as hard drive makers like Western Digital and Seagate. So they create equipment that allows these companies to perform performance benchmarking. What they also do is they manufacture robotics and robotic arms, as well as autonomous robots that's used in manufacturing. So they're experiencing an interesting tailwind, which is the shift towards automation. So this is something that's not necessarily what value investors look for, because it's a little bit more, what would you call it, next generation, if you will. Not really a company that's been doing the same thing well for the last several decades, but it is something that is shifting towards what we might be seeing more and more of over the next 10 to 20 years, which is shift towards manufacturing automation. But this is what we want to find, is companies that trade at a discount to intrinsic value, but also companies that have a attractive path forward. So if we read page 3 here, we can see exactly why this company is positioned for growth into the future, into the next 10 to 15 years. And we can see that exactly what they do is they are a leader in semiconductor testing. And that's really an area that not a whole lot of players really specialize in. So they do have, in my opinion, an economic moat. So we're actually going to see that in the ROIC section here. If I come here and type in Teradyne, how do I know that there's an economic moat? Well, again, just like what we saw with the other companies that we looked at, Best Buy and Sprouts, companies that consistently do high ROIC are not only generating high returns on capital, but this is evidence of an economic moat that they have. Because if a company can do this for many, many years, then that tells you that they're doing something that not many others can do. And check this out. Look at the growth in their ROIC. Not only do they do very high returns on invested capital now, but the rate of change is phenomenal. You can see that they're at 35%. That is very, very attractive. And you can see down here at the bottom, I didn't talk about this for the other two companies, but adjusted Ebit is another way of looking at this, which basically adds back the R&D that they do. So we're looking at operating income before R&D and simply adding R&D to the denominator. So we're assuming that R&D is an investment, not an expense. And looking at what the ROIC might look like in that case. And you can see that number is just absolutely bonkers at almost 45% here, 43.5%. So this is a excellent ROIC. So for a stock that trades at only 23 times earnings, right? So it's in line with the market, but it has an ROIC that is more than 3 times the market average. We can see what the market average is. This is not the same exact approach as I have in the spreadsheet here, but we can see kind of an idea of what it might be. And look at that here, at 6.25% for the S&P 500 average. Teradyne at 32%. This is not the same approach as what I have in the spreadsheet, but it does a good job of coming pretty close. Where Teradyne, again, you can see that massive spread. So we have a company that trades in line with the market, right, at a 23 times, at a 23 PE, but has a ROIC that's 5 times higher. That is very, very attractive. And the same thing goes with what we see in the intrinsic value estimate versus, the current market price. There's been a great, multiple expansion that we did see so far in 2020. But that's, in my view, justified because of how efficient this company has been, how great its return on invested capital is. So again, if I were to use the least squares growth rate, we can see that, if we were to assume just a 10% growth rate, that margin of safety there is 13%. So not as big as what we saw previously for the other companies, but still a very, very good, growth rate nonetheless. If I were to go back to our default model here at 11% growth, which is what analysts are expecting, 24% upside right now, and a 38% upside over the next 1 year. So this is a company that is a little bit less deep value per se, but because they're positioned for growth over the next 10 to 15 years, thanks to their investments in robotics and automation, for a company that trades at just 23 times earnings, this gives you a little bit of growth and value and ROIC altogether. So overall, very, very attractive numbers here. Autozone is the other one, AZO. This is a retailer, obviously another retailer that specializes in basically one of the largest retailers of aftermarket auto parts, right? So it's always interesting to note, what are these companies doing to weather the growth of online? And if I were to just start with the ZVM model here, again, not making any adjustments, just taking what analysts are expecting the long-term earnings growth rate to be, again, not making any adjustments here, 31% upside. It's trading at a PE of 15 times earnings. And this is actually a member of our earnings certain portfolio. So if you are familiar, the earnings certain portfolio is our highest conviction list of companies that have had, the most stable earnings growth over time. And if you look at Autozone here, just absolutely stable and very, very predictable, very smooth earnings growth over the last 30 years. You can see that we've gone through multiple economic environments, multiple interest rate regimes, multiple external shocks, and you can see that through each and every one of those crises that we've been through, AutoZone just continues to execute well. It's just one of the most amazing, well-run companies here. And for a company that has this level of stability and this level of execution, for it to trade at just 15 times earnings, that is a very, very attractive multiple. And again, if we were to look at, the, current market price adjusted for the growth rate that it has, again, it trades at a very attractive, margin of safety there. So again, assuming just 6.5% growth, 6.7% growth, we see a very, very high margin of safety. If I were to type in the ROIC for AutoZone, we can see exactly what the ROIC has been, and this is a little bit of a different story, as we're going to see here in just a second. They have a little bit lower of an ROIC right now, as this chart is going to show here. So this number has actually been trending down, and this is what the concern has been. It's still a very attractive ROIC at 33%, which is again phenomenal compared to a 6 to 7% for the S&P 500 average. But the concern is that this has been coming down. However, if you look at it on a 1.5-year lag, right? This is that number that we look at to show that investment takes some time to bear its results, right? That number has not come down by as much. So what this is telling us is that this company has simply been investing in growth, in expanding its number of stores, and that's why this ROIC is coming down. So on a concurrent basis, the ROIC is coming down, but if we lag the denominator by 1.5 years, you can see that it's been stable at about 50%. So that is, again, very, very attractive. So today's Ebit is roughly 50% of the invested capital from 1.5 years ago. So whatever investments they're making today, the Ebit that they generate over the next year and a half is going to be roughly 50%, which is, again, very, very attractive. That's an excellent return per dollar of investments that they're making. You can see that their invested capital really has accelerated over the past year. So they have been investing in growth, over that time period. So we expect, this number to rise in conjunction with that over the next year and a half. So again, that's exactly what we like to look for. The other company that we had in our list is Hewlett Packard, right? Hewlett Packard is a company we've known in, through the 1990s. It was a darling of the market in the 90s, with the rise of the internet. This is a stock that is very cyclical. It's deeply cyclical here. So, but if you see here, it's trading right now at a PE of 9. And so if I were to type in our expectation here, check this out. Our base case is actually an earnings contraction of minus 0.5%. So even if this company were to contract earnings, for the foreseeable future, you can still see that the implied, what the multiple implies into the stock price right now is still higher than, what the market is, pricing its equity at right now. So again, the multiple is implying a earnings contraction even deeper than what we are modeling here. So what is that? Let's type in, if I click on this MIG button, on your ZRS, it might be on the top left corner. I just moved the bar to the right, so depending on where your orientation is, it might be up here. That's kind of the default here, but I just like to move it over to the right here. So MIG, if I click that, that's going to tell us what the implied earnings growth is for HP, and that's about a minus 2.8%. If you think that HP can, beat a negative 2.8%, then this is a buy right now. If I were to type in the least squares growth, right? This is our growth rate on average over the past 30 years at 5 point, almost 6%. You can see what that margin of safety now becomes. So this is a growth rate that if we were to model the midpoint of their growth over this entire time period here, not factoring in the bull markets and also not factoring in the deepest earnings troughs here, but somewhere right in the middle, right, an average of the two, then this becomes our margin of safety. So the big question is, can they actually grow earnings at 6%, right? And so that's what the research report comes in at. What is really been the driver behind Hewlett Packard? What are they doing right now to position the company for growth? Because right now the market, the buy side is saying that they can't grow at all. In fact, they're experiencing a contraction. So the big sort of area that I think that they're going to be investing in, what we all know what HP does. We all know HP makes computers and laptops. We know that they're really good at printers, right? That's been sort of the big driver of their business for a very long time. But what are they doing for the future, right? And one thing caught my eye in our report here is this point right here. Apart from fortifying its traditional printing product portfolio, HP is focusing on enhancing its 3D printing business capabilities. Notably, the 3D printing market presents significant long-term investment opportunities as a large number of engineers, designers, architects, and entrepreneurs are now turning to 3D solutions for primary designing and product modeling. Thus, in order to establish its base in the space, HP unveiled its Jet Fusion 3D printing solution last year. So the company believes that its expanded product portfolio, materials, industrial partnership will help it cater to the needs of a growing range of customers. So 3D printing is, I think, what the big sort of next step would be for a company like HP, which has so much expertise in printing, in manufacturing, in these devices, that 3D printing is sort of the next step, or the hand in glove fit for the company to evolve itself in the next generation, and that's where their investments really have been going in making that there. If I were to look at their ROIC, check out HP here, HPQ, or type that in and click on refresh all. This is the big part of why it is something that is for a company that trades at such a deeply discounted multiple at under 10 times earnings. Look at their return on invested capital. So this is a company that is extremely efficient at generating returns on its capital at 42%. You rarely see a company trading at 9 times earnings and have an ROIC this high. And you can see the growth in that as well over time on a gross profit to invested capital basis. So this is the other part that I like to look at too. I like to look at gross profit sometimes, because if a company is making investments in R&D, which absolutely is the case, then sometimes looking at gross profit is a better way to look at where their gains are coming from, right? Where the increase in efficiency is coming from, as well as this adjusted Ebit, which again adds back the R&D and to Ebit and adds it to invested capital, so it shifts it from an expense to an asset, and you can see again what that number looks like at 50%. So for a company that trades at such a deep discount to its to the market, as well as to its peers, this is a phenomenal, in my view, business that has been doing quite well. And the big part of what we want to focus on is, for a company this cheap, we just want to make sure that they're not falling out of favor. And that's been the case here for the last couple of years. If I look at revenue growth, you can see that it did drop quite precipitously in 2015, but you can see that that it's stabilized now since that time period. And now we see that the company is investing in growth, especially in 3D printing, and I think that's a very, very promising part of what they're doing and positioning themselves for the next several years. Um, so, again, that big drop in revenue is the reason why the stock has traded at such a big discount. But in my view, for a company that trades at 9 times earnings and has a stabilized revenue here over the past 5 years, it's not high growth, but it's still growth, and it's not dropping here at roughly 2% earnings, revenue growth. For a company that's trading at such a low multiple with stable revenue growth, positioning themselves for the future in 3D printing, and are extraordinarily efficient at generating returns on its capital, I think it's a great deep value opportunity right now. And lastly, AbbVie. AbbVie is another huge one of my favorites. And before I talk about AbbVie, full disclosure, I do own shares personally in AbbVie, so I want to make that clear before I talk about it at all. Just out of full disclosure and fairness. So AbbVie is the global leader in oncology, as well as hematology and immunology, I should say. So the big idea there has been the big driver of their sales has been Humira. Now, the problem with Humira is that there is significant competition that's coming onto the market around 2023. So that's the reason why, if you can see here in this chart, the stock has had a big drop from 2018 to 2019, from about $120 a share all the way down to almost $65 a share. So the stock has really been cut in half, right? And that's the big that's the big concern that investors have, is their biggest revenue driver is Humira, and Humira is going to come under extreme competition. However, if we look at what they've done to combat that, they made a huge acquisition in Allergan, and that is what the company believes will be, the way that they can hedge out their dependence on Humira. And if we look at what there's actually a great sort of corollary to this, which is under the estimates tab under models. If I were to go to their consensus forecast, I'm not going to do it right now just out of the interest of time. But what you will discover is that the acquisition of Allergan was specifically to hedge their over-dependence on Humira. And because of that, I think the evidence is clear, and analysts also believe now that their product portfolio over the next 10 years is going to more than replace any lost sales in Humira. So if I look at the price to earnings multiple on AbbVie, this has been what's been priced in my view. The stock trades at an extraordinary discount. Right now it trades at 8 times earnings. So in my view, the company has already been priced for that big risk that they've had. But because they've gone out, made that acquisition, because they've gone out and pushed their pipeline of other drugs to replace that lost revenue from Humira, if you look into it a little bit deeper, you will see that. I'm not going to go into it too deeply just out of interest of time. But in my view, the stock is actually already priced for that. And for such a deeply discounted stock at 8 times earnings, actually got all the way down to about 6 times earnings during the COVID crash last year, which was just an epic buying opportunity in my view. Look at their revenue growth over this entire time period. 11% growth, almost 12% growth over this 5-year period. And it's actually above trend right now. So for a company this cheap, it's got, quite impressive revenue growth, right? So again, this is something that we wouldn't really expect. Or to go back to the price and earnings, the PE multiple, how does this look like on a relative basis over time? Because we can see that AbbVie's kind of always traded this cheap. But if I look at it on a relative basis to the market, look at that. Right now it trades at a 62% discount, or a 62% discount, when on an average basis, it trades at, a almost a 40% discount. So it's an even steeper discount to where it normally trades at on a relative basis to the market. And even if we change it to the sector average, right, relative to healthcare stocks, again, very, very deep discounts. Even if I were to switch it to the industry group, again, a very steep discount to even its own, industry group within drugs. So again, this is a phenomenally discounted company, and Warren Buffett recently announced, taking a stake in AbbVie as well. I think he's also seeing what I'm seeing here. So again, this is a phenomenal, company. It's a world leader in oncology. Their drugs include solutions for rheumatoid arthritis, in Crohn's disease. So they are a sort of a global leader in that. If I shift over to the ROIC and type in AbbVie in here, let's see what their returns on capital look like. So if I refresh that in here, again, these are all companies that have huge margins of safety because of how low the multiple is. The expectations for growth is very, very muted. So if a company does very good ROIC, then that gives us increased confidence in their ability to grow earnings. So their future forecasted earnings growth we can make with higher predictability. Now, if we look at this here, ROIC, it's at 10%. So that's not as good as what we normally look at for the other companies that we saw, right? However, if we lag it by a year and a half, again, this is another thing that we are starting to see as a common theme here. That jumps to about 25%, and that looks pretty consistent. However, if we shift down here to the bottom and look at the adjusted EBIT, right? So R&D is a big, big factor for, especially for companies like, AbbVie and others, because R&D is a huge component of their P&L. If we add that back and put it into the denominator with a 1.5-year lag, that's where we start to see the value that AbbVie is creating here. 34% return on that invested capital on a 1.5-year lag. So this is exactly what we want to see here. High ROIC or increasing ROIC on one of these charts here. It's always going to be one of them. Not all of them is going to fit in nicely because every company is obviously unique. Every company is doing something quite a little bit different. Some companies are investing right now heavily. Some companies aren't. So, it requires a little bit of analytics to really understand what the relevant number would be for the company. And this is what I like to see here. As long as one of these charts is very high and stable or moving up and to the right, one of those two factors have to be, present. So we see that they're, again, very, very strong and attractive returns on invested capital. So I'm going to leave it there. Obviously, we can do a lot deeper dive into these companies, but out of the interest of time, I will stop here and take some questions. So the first question is, do companies that meet these metrics typically have a low beta? And or do they seem to be less volatile on the downside or price action? Great question. A lot of these companies are low beta because they are such low multiple stocks. I will make a couple of exceptions like Hewlett Packard because that company is very cyclical in nature. It's kind of like the semiconductor industry. It's kind of like, ARM Holdings and those types. So they do have cyclicality to that. But for AbbVie, and I believe for Sprouts as well, and as well as AutoZone, those companies are a little bit lower beta. So yeah, that does have a little bit of a correlation, but it would be on a case-by-case basis that we should really take a look at that. The next question is, deep discount stocks that are still not widely known, are they synonymous with low beta? So again, a pretty similar question there. There definitely is a correlation, but it's not always the case. So I would want to look at that on a case-by-case basis. So low beta, again, that has to do a little bit more with price volatility as a covariance relative to the market. So again, it's a good question. I would look at it on a case by case basis again. So if there are any other questions, I know we're running a little bit over time here, but if there are any other questions, please do email us at zrs@zacks.com. Again, zrs@zacks.com, or you can reach me directly at mthaker@zacks.com. So I hope you found this. Valuable. If you do have any questions or if you have any ideas on future webinars, we'd love to hear from you. And hope you found this helpful. And again, please do reach out to us with any questions, or if you want any of these slides that we did, please do reach out to us anytime, and I'd be more than happy to help you out with that. All right, everyone, take care, stay safe, and hope to see you guys on the next call. Take care. Bye-bye.